Welcome everyone. In this video, I have something exciting to go over. We're going to be talking about Snowflake. It is a new holding to my portfolio, the Story Fund. And I'm going to be explaining why I purchased into this company and what I expect of it over the next 5 to 10 years. Snowflake is right there. I have about $2,000 invested in it. It's a very volatile stock. So this is in a category of its own. There's a lot of companies in the Story Fund, a lot of growth companies. When you talk about growth companies, typically what that means is a company that grows its revenue about 15% or more year over year. That's really what a growth company is. They grow their revenue 15% more year over year. Now, hyper growth companies is a term that I don't use that frequently. And I don't use it that frequently because there's not a lot of hyper growth companies. A growth company may grow its revenue 15 to 40, maybe even 50% year over year. A hyper-growth company grows its revenue 90% year over year, 100% year over year, sometimes even more than that. And they can keep that up quarter after quarter after quarter. That is a hyper-growth company. So Snowflake falls into the category of a hyper-growth company. This company is growing its revenue over 100% year over year, sometimes 120% year over year. They grow their revenue so much, it's incredible to put it up against other companies. Check out this chart. This is the quarter over quarter revenue growth of Snowflake from 43 million in Q1 of 2019 to 60 million, from 60 million to 73 million to 87 million. This is quarter over quarter to 108 million, 133, 159, 190, 228. This is growing its revenue at a pace similar to the annual growth rate of a normal growth company. So literally, they're growing their revenue quarter over quarter as fast as most good growth companies grow their revenue in an entire calendar year. Snowflake is growing that much in every 3 months. That is pretty incredible. There's not a lot of companies that can do this. Now, with that growth coincides one of the most expensive price points for Snowflake. It is trading at nearly a 100 times trailing 12-month revenue multiple. That's one of the most expensive companies on paper in the markets today. So Snowflake is both one of the fastest growing companies in the market by far. In fact, it is in a category of its own. Snowflake is not a growth company. That is the understatement of a century. It is a hyper growth company growing its revenue well over 100% year over year. And it's done that for 5 consecutive quarters now. It's grown its revenue 100% year over year on an annualized basis. And that's with a lot of revenue coming in, over 200 million per quarter. So this is a fast growing company. It's a hyper growth company. It's an expensive company based off of its current metrics. And I'm going to put all of this in context. Why are people paying so much for this company? And why is it growing so fast? What is the opportunity for it? How big can this company eventually be? We're going to talk about all of it in this episode. So if you like this type of content, before I jump in, just a reminder, you can hit the thumbs up button. That helps out the YouTube algorithm. You can also check out the Patreon. That helps directly support this content so we create more of it and we have a good community here. Just some things to check out and to consider. Now let's go ahead and jump in to the main subject at hand. Like I said, I'm buying Snowflake. It's right here. I have it at a 3% target allocation. Because this company is so volatile and people buy and sell it so quickly, I wanted to put in $2,000 as an entry point and then keep some cash on hand in case it drops. So I have another $500. If it drops a little bit more, I'll inject that next $500. But this is a company that is not one that you want to hold for like a couple months unless you're a day trader. This is a long-term holding. In fact, I'm looking at this one at a time horizon of at the end of this decade. So 2029, 2030, that's when I'm kind of looking for the story of this one to really play out. But there'll be a lot that happens between now and then, and we'll get a good idea of how, if this company will get to its full potential. So that's the holding right there, 3%. And I adjusted a couple other companies to make room for this one. Just a couple other ones down 1%. So if you want to see the updated portfolio, there's a link in the description, and that has my total allocation. Now let's go ahead and look at, first of all, how did this company get started and what problem does it solve? To go to how it gets started, we can reference this little fun video here This gives you an idea of the two people that started it and why they started it.
Once upon a time, in a country known for its fine art and architecture, two boys were born, Benoit and Thierry.
You know, Thierry, I love data and I love computer science.
Me too.
Those two guys that started it. This video is a little coy. It's not like this intense, tactical, aggressive video, right? This is a friendly one. Those two guys are geniuses. They're incredibly good database architects and database analysts, and they've worked in this industry their entire life. And they're so good that they got investors' money early on. Investors had a lot of confidence with them to be able to re-architect it. So it is a little underselling their abilities in this video.
Not only did Thierry and Benoit love big data, but they grew pretty fond of each other.
And I think you would call it a bromance.
Benoit was given the opportunity by an early investor to re-architect a data warehouse in the cloud entirely from scratch.
That's the big point right there. That can't be understated, or this can't be overstated enough, right? They were given the opportunity to re-architect a data storage, a data lake, a data warehouse. There's all sorts of different aspects to it, but basically a data storage from the cloud first. Every company, you name it off, Amazon, AWS, Microsoft Azure, the Google Cloud, MongoDB, whatever it is, they were not architected from the cloud first. All of those were based off of legacy architecture that they brought to the cloud. And that was a big feat in and of itself. That was a big iteration in data storage. But these guys took a different approach. They architected it from the cloud first. And with that, they solved many of the technical issues that you run into when you do it the other way. So they solved a host of problems that companies right now are finding very useful with Snowflake. And right now, Snowflake is ahead of the big guys. They're ahead of Amazon with AWS and Redshift. They're ahead with Microsoft Azure. They're ahead of Google. They're ahead of all of them. And that's why so many companies are using Snowflake.
And I knew that there was no way I could build Snowflake on my own. So I needed Thierry because together we have amazing idea and he's the most optimistic guy I know.
They decided to quit their jobs, buy a printer, whiteboard, and start working out of Benoit's apartment in San Mateo.
So basically we propose a brand new architecture for the cloud. It is an architecture which is designed to support fault isolation, performance isolation, and elasticity of the cloud.
So what we wanted to do is to build a system that would adapt, the resources that was used based on the demand, such that for customers they would only pay for what they use, and also so that the system would.
That's it. The system scales to infinity. Customers only pay what they use, and that's an important part. We talked about Twilio and how they have a usage-based billing economic system. Same thing with Snowflake. And that's better than a subscription service. In fact, it might actually be a better economic model than subscriptions. And I'll explain why later in this episode. So going into the technicals of Snowflake and trying to explain the advantages of this company over other offerings, like all the other database offerings, is very difficult if you don't have any technical background. There's a lot of posts on Reddit that I've looked at, and I've done research on this company over the past week. I've been looking into it in depth, and I find a lot of, like, for instance, this post right here. This is on data engineering and Reddit, and it's just people asking about Snowflake and how they stack up to other offerings. And when you ignore investors, so when I say I'm not going to pay attention to investors, I want to actually look at it from a customer perspective. Why are customers picking this? Why are database engineers picking this? Why are big companies like Adobe going with Snowflake over other offerings? This gives you some insight. This is actual database engineers and analysts on Reddit saying why saying what they honestly think of Snowflake. This one right here says, we currently use both SQL. This is like the go-to, it's been the staple of database storage for a long time. I'm very familiar with SQL. That's SQL and MySQL. That's basically what I built all my applications in. It is a wonderful database, but it's been the staple for the past 30 years maybe. He says, we've used SQL Server, MySQL, and Snowflake at work, and we've decided to start transitioning over to Snowflake because the pros far outweigh the cons for us. And I've heard very similar feedback from other companies that have switched to Snowflake some reasons why. He lays out a number of different reasons. If we want new features with SQL Server, we'd have to go through the process of upgrading it to the next version and doing all the necessary testing. That is problematic. With SQL, whenever you do an upgrade, it has the possibility of breaking things by different format changes, and that often happens. So you have to do a lot of testing before you upgrade it so that the stuff that breaks you're aware of after the testing before you push it to a live server. He says, but with Snowflake, new features get rolled out as they come, and they're available for us if you want to use them. Makes upgrading not a pain. It doesn't have any time-consuming element for your developers. So right there's a big pro of Snowflake over just SQL. Having the ability to throttle resources dedicated to queries and tasks is pretty amazing. It's so much more user-friendly than SQL Server and actually gets stuff done a lot faster in Snowflake. This is one of the most repeated things I've read from all different posts on Reddit and other forums that are full of database engineers, is they just say it's easy to use. They love how simple it is to use. They transition over it and they're like, wow, this isn't complicated, not complex, not confusing. I can use my experience and I have to learn a few little nuances with snowflakes, but it's surprisingly easy. That even small teams, even companies that have like 3 database engineers or even 1 could implement Snowflake. So that is a big thing. If the product is so complex that you need to have some Fortune 500 company that has 50 developers plus to be able to even figure out the product, that's no good. You have a very limited group of companies you can sell that to. Snowflake is incredibly easy to use. And I've heard the same exact thing from a developer I know personally that worked at it's a medium big size company that uses Snowflake. He said that everybody loved how easy the onboarding was, how easy it was to use the program or the platform. They say, as far as it relates to development, execution, and review of queries, you might attribute this to having more experience in Snowflake versus SQL Server, but even the key shortcuts in Snowflake help me get work done faster than SQL Server. That can't be stressed enough. It saves developers time. Tasks and streams make ETLs within Snowflake a lot quicker and less intense on resources. For my company, the data sharing feature is extremely important. Snowflake has a ton of things where they basically package the data and they warehouse it and store it in a much more convenient way for developers. So they actually have every single thing saved. You can go back 90 days to literally any second and be like, I want the database right then. Boom, I have a copy of the database then. That's incredible. You can't do that with SQL. And people think that feature is fake until they use it. Database analysts are like blown away by that feature. So they have some incredibly powerful features. This one, he says, for my company, the data sharing feature, which is another one built into Snowflake, where they make it so you can easily share data, especially amongst other Snowflake customers, which builds a little bit of a moat because it gives you incentive to use it. But you can package data in Snowflake, share it amongst customers, and they even have it so that you can like bill customers for that data. Incredibly powerful stuff. He says, and it's likely the primary reason we started looking at Snowflake. 90% of our data comes from another company that uses Snowflake via data sharing. And about 15% of our data goes to clients of ours via data sharing. I personally love having a Snowflake reaches out to me proactively and informs me of upcoming changes, configurations needed. Okay, so he's saying that they're proactive in what they're doing with Snowflake. The company, from what I can tell, has very good customer service. He says the time travel feature has been handy a couple of times. That's going back to any time point. Snowpipes, enough said. It goes on. There's more posts like this. Believe me, there's a lot of them. There's another company here that explains why they transitioned over to Snowflake, and they did careful analysis between Snowflake, like their development team, between Snowflake and other offerings. And they just said Snowflake had a better offering. They said BigQuery, for instance, is only available on Google, but that wasn't the only point leading us to choose Snowflake. So he's comparing Snowflake to BigQuery. He says, here's a couple reasons of why we chose BigQuery, or why we chose Snowflake against BigQuery. This is their internal documentation. He decided to share this of why they ended up going with Snowflake. And I won't read through all of this because it gets a little monotonous, but he says Snowflake supports native JSON while BigQuery only through UDF. Snowflake supports partitions on any column type, while BigQuery only supports dates. Snowflake doesn't support Google Cloud Storage at the moment, only AWS and Azure, but they are working on it. Well, this was a couple years ago. Now they support Google Cloud. So with Snowflake, if a company goes with Snowflake, they are ensured that they can move from AWS to Azure to Google Cloud. They can move between the two. So if Azure, for instance, decides to do something they don't like, that company doesn't like, or they decide to raise their prices a lot, Snowflake can shift over to a different service. So it gives the company the power. They can shift over to whoever they want as their big data hosting service to use Snowflake's offering of the data storage and the data lake. Everything with Snowflake, by the way, everything is stored on public cloud storage. So it's either Amazon AWS, it's Microsoft Azure, or it's Google Cloud. It's one of those companies. So in a way that they're kind of competing against those, but they're also working with them. It's one of those weird relationships. But anyway, he goes on, it has all these different things that he highlights. Snowflake has advanced analytic capabilities, so on and so forth. So that's just a couple examples of why developers and engineers are choosing Snowflake over the competition. And I could go through many more. We could spend 3 or 4 hours going over all the technical capabilities of Snowflake, why it's superior to the competition. That would get a little bit boring. So I want to move from that to the valuation, because this is where things get a bit crazy. Now, this is a very busy screen. Ignore most of it. Just look at the very bottom right here. These panels that are colorful. This tells you the next 12 months revenue to market cap multiple of these companies. So how expensive these companies are based off their projected revenue over the next 12 months. Salesforce is the cheapest with an 8.2 times next 12 months multiple. So the market cap is 8.2 times their expected revenue over the next 12 months. That's pretty cheap. I think Salesforce is an easy buy. I'd be buying that company, and I am buying that company. Then we have Microsoft. That one's 10.7. Then we have Adobe, more expensive than Microsoft, 16.4. Then we have Palantir, a company that has some similarities to Snowflake, but not entirely the same. Palantir is more around the government and big government contracts. You have a lot more consulting-based stuff, right? They're not quite as productized, a little bit different of a company, but in the same area. That one's trading at a 29.3. So it's almost double the price of Adobe. Then we have above that, Cloudflare, a cybersecurity company that's doing a lot of different things. They're growing like crazy. It's a hyper-growth company trading at a 44.5 times next 12 months revenue. That is incredibly expensive. But then we have above all of them, we have Snowflake at a 56 times its next 12 months projected revenue. Now I realize, looking at that multiple and that staggering number, 56 times its next 12-month multiple, you could conclude that I am insane for buying a company that expensive. And without context, I think that's the proper conclusion. But what I'd like to do is explain why I'm buying a company this expensive, because obviously I have very high expectations for this company. Let's go ahead and take a look at their last quarterly report. I have the numbers right on the screen here. Here's the highlights of it. The product revenue was $213 million. That is a growth of over double, 110% from this quarter to the same one year ago. So the company's revenue doubled, and this is the 5th consecutive quarter that they've doubled over the past year. Pretty good growth from them. The most amazing thing I think out of this entire quarterly report is their net revenue retention rate. If you're not familiar with what this means, it's how much money you're making per customer on the same customer account. So they had a net revenue retention rate of 168%, which means that on average, for every dollar they earned from a customer last year, they earned $1.68 from that same customer. Their customers are paying them more money year over year. They're using their product more and they're paying them more money. Another way to put this is Snowflake could have gained 0 new customers over the past year and their revenue still would have grown by 68%. How many companies can say that? How many companies can say, yeah, I gained 0 new customers, but my revenue grew by 68%? Not many. In fact, I don't know of a single other company that does that. Most good net revenue retention rates are somewhere around like 120%, 168 is insane. This is insane net revenue retention. I don't see this anywhere. Their total customers, of course, grew as well. They have a total of 4,500 right now, so they're growing the number of customers 67% year over year. That is astronomical growth. They're growing their customer base by 67% in 1 year. Also, their $1 million customers, the ones that pay them over $1 million per year, grew by, you can't see it right there, it grew by 117%. So another over doubled their $1 million customers. So this is a company that is attractive to customers, to different companies, big and small. They have the big fish right here, the big $1 million 7-figure customers. Then they have the small fish. You have thousands of these and they have hundreds of these. So they have a product that they can sell to both big companies and small companies. It's a huge market available to them. Now, we can also look at the Fortune 500 companies. They have 187 Fortune 500 companies using them. That's a growth of 30% year over year. And then we get into some other statistics that I don't think are quite as meaningful. It's like satisfaction ratings and stuff like that. It's all very good, but you get the point. They're growing the amount of customers, both big and small, and then each customer is paying them substantially more year over year, and that's expected to continue into the future. If we look at this PowerPoint here, this is the last thing I'll go over. This is their path to $10 billion. And this is something they put together where they actually think they can grow their revenue to over $10 billion per year by 2029. If we look at this, they say, first of all, we're defining a new market. Cloud is growing like crazy. They're taking advantage of that. I want to get into some of the slides here that I think are very important because they have a lot of different information we could look at. Here we go. The path to 10 billion. When this report was made, they only had 77 $1 million customers. Now we just saw that they have 104. So they grew it like another 30 in the last quarter. So they're signing up a new $1 million customer like every 2 days, it seems like. Their target for financial year 29, so the end of this decade, is 1,400. That's how many they want. 1,400 customers that pay them over $1 million per year. They say the average product revenue per $1 million customer they think will go up substantially. Right now it's 3.4 million. So $1 million is just the minimum. On average, they're paying them 3.4 million, and they think that will go up to 5.5. So not only are they going to gain more customers, but again, that net revenue retention rate is going to go up substantially over the next 8 years. Then we look at this, the percentage of product revenue from the $1 million customers, it's going to go from 47% to 77%. So they think these big customers are going to make up a bigger portion of the pie. And they look at the product revenue, $500 million to 10 billion. That's what they're looking at. If we go on their long-term operating model, they have all these projections again for 2029. We can look through all of them here. Their product revenue, they think, will be 10 billion. Their product revenue growth year over year will be 30%. So this is actually pretty incredible. They're projecting that even after they grow to $10 billion in revenue in 2029, they're still projecting growth at that point of 30% year over year. So they're not saying they're going to slow down growing that much. They're going to continue growing even past 2029. That's their projections. Now, you can take this with a grain of salt, I guess, because it's the company's projections, but even third-party analyst firms like Morningstar have more bullish projections than this. They say that they'll be at 13 billion by 2029 based off of Morningstar's projections, and they'll continue to grow even faster. So it's not just Snowflake saying this. In fact, Morningstar thinks that Snowflake is taking a conservative approach with their projections. And I would agree. I think with the market, with their revenue growth, with their client base, and the nature of the product and their business model, I think that this is a pretty conservative projection. But going on from this, the other big number is they have operating income projection of 10% at the end of this decade, which means, for instance, at 10%, that means that if they revenue $10 billion, they'll have free cash flow of $1 billion. So this will be a profitable free cash flow company with growing revenue that's reliable in an incredibly important market, which is big data and analysis. That's a big opportunity here. Now, what does all this mean for the stock? We're looking at the stock price here. It's $238. Is it a buy? It has impressive numbers. The company's growing fast. It seems to be in a good market, But is it worth buying right now? That's the big question. Well, unfortunately, this is not a perfect science. I know that some people like to plug things into their projections and calculators and come up with a perfect fair value for the company, but I think there's a simpler way to look at it. Let's assume that the company does meet its goals of revenuing over $10 billion per year by 2029, and it has free cash flow margins of 10%, so it has $1 billion of free cash flow, and it's growing at 30% plus year over year. If it hits those metrics, the company will be worth, in my opinion, substantially more than what it's trading at right now. It won't be worth $70 billion. Investors will be paying upwards of $150 billion to $200+ billion for that company. That's what I think. I think if it's revenuing $10 billion, growing 30% year over year, and has 10% operating margins, so you have free cash flow of $1 billion plus per year, this is going to be something people want to own way more than they do now. So I think at a conservative estimate, if the company does meet its goals, which I think is likely, I think the company will be worth roughly 3 times as much. That's the reason I'm buying it. Now, is there any guarantees here? No, this isn't car insurance. We're looking at companies, we're doing analysis, and we're buying them based off of our own experience and expectations and what we see with the future of these companies. I'm not making this the biggest bet in my portfolio. I have companies that are more sure bets like Microsoft and Amazon, but this is one that I think is a pretty big opportunity and I want to take a bet on it. So I've done the research, I'm adding it into the portfolio, and we're going to see how this plays out. Will this stock outperform or underperform the S&P 500 over the next 5 years? We'll have to wait and see. Now, I hope you enjoyed this look into the company. If you have any questions, ask them in the comments below. Also, you can consider subscribing to the channel, liking the video if you haven't already, and I'll talk to you guys next time.